Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. A news from one of the world's leading financial centers has a strong sense of deja vu about it. The free fall in the stock of Credit Suisse and a string of departures from the top signal that there is something wrong with the Switzerland's second largest bank. Its newly appointed CEO Ulrich Kuhner too had conceded that the firm was facing a critical moment and needed an overhaul. And just like Lehman Brothers in 2008, the financial cost of potential collapse of Credit Suisse would be huge. Our next report tells more about it.
Just a week ago, 14 years after the bankruptcy of Lehman Brothers triggered a global financial crisis, the liquidation of its brokerage unit ended. More than $115 billion was paid out to Lehman's 1.1 lakh customers, secured and unsecured creditors, and a trustee who oversaw the brokerage's liquidation and his law firm. Lehman Brothers had been US's fourth largest investment bank before filing the largest bankruptcy in American history by far on September 15, 2008, leaving over $600 billion in debt. Today, on the other side of the Atlantic, growing concerns over the financial health of Switzerland's second biggest lender, Credit Suisse, have sparked fears on whether the world should brace for another Lehman-like financial fallout. Its bigger Swiss peer, UBS Group, had received a state bailout in the 2008 crisis. Credit Suisse has been assuring staff, counterparties, clients and investors that its liquidity and capital position are strong. But its shares have fallen 55% over the past year, giving it a market cap of about $11 billion. This is lower than several Indian banks like HDFC Bank, Axis Bank, SBI, ICICI Bank and IndusInd Bank. One of the biggest banks in Europe, Credit Suisse had $1.6 trillion in assets under management at the end of 2021. It has wealth management, investment banking and asset management operations, besides a domestic Swiss bank. Swiss Central Bank had designated it one of the country's global systemically important banks whose failure would cause significant harm to the Swiss economy and financial system. The bank's credit default swaps, an instrument that measures the cost to insure its bonds, hit their highest level since 2009. CEO Ulrich Kuhner, who took charge in August, is attempting to restore the bank's profitability. Over the past 3 quarters alone, Credit Suisse's losses have hit nearly $4 billion, while ratings downgrades increased its financing costs. The collapse of US family office Archegos Capital Management cost the bank $5.5 billion last year. It suffered further losses from lending to the now defunct supply chain finance company Greensill Capital. Multiple changes in top leadership since 2020 and high-profile risk management failures have also attracted investor scrutiny. The bank is due to present a transformation plan when it releases third quarter results on October 27th. Credit Suisse had total assets of $735 billion at the end of June. The strategic review launched by the new CEO will focus on strengthening the bank's flagship wealth management business and scaling back investment banking into a capital-light advisory-led business. Asset and business sales are also on the cards. It is also evaluating strategic options for its securitized products group, a trading business. Analysts estimate it could face a capital shortfall of as much as $6 billion.
If I compare it with the Lehman movement, so when Lehman got bankrupt, they had an asset under management close to $600 billion, right? And today we are talking about $1.2 trillion. So the catastrophic effect can be much higher if the government don't support right now. Because these kind of institutions can only be supported by governments. No individual, no other institution apart from government can support at this moment. So we all are waiting for the government response, how they are going to handle the situation currently. It will create a systematic issue for the entire European economy and at the time when they are already passing through a crisis. So I believe temporary, of course, will have a ripple effect. But in India, I can assure you, whatever impact will be, it will be very short term. So we believe, yes, we will have a technical correction once any of the banks go belly out across the world, whether it's a US bank or it's a European bank. But in Indian market, they will not remain down for a long time. You will always see a V-shaped recovery for Indian stock market.
Given the negative news flow, Citigroup analysts see significant execution risk in any new strategic plan. In the short term, they said widening credit spreads can exacerbate market fears and damage counterparty confidence as well as drive funding costs higher. And in the long term, the fall in its share price will further dilute its capital raising capability, and it will throw a spanner in the plan for any investment banking restructuring that Credit Suisse can undertake.
Now, with the CDS being impacted because of the almost sort of a very consistent pattern in interest rates rising, right, have put almost everybody who were comfortable with low interest rates on a hook. You have to take this and read it with maybe another layer of understanding that how Eurozone is struggling. There is stress at a politics level. There is stress at an economic level. Now there is stress at the cost of money level. Banks are extremely leveraged institutions. And that's why they wind up so soon. Lehman Brothers, Bank of America, Fannie Mae, Freddie Mae, all these guys, they only needed hours to unfold. Right now, they are fearing this because that is one that will possibly, in my mind, have the maximum contagion. Thinking that if the bank goes bad and it will be an isolated case, I think is not the right manner. We have to realize that this will have an impact. Right now, when Credit Suisse is under the stress, your other banks also is going to feel the heat. So it will have an impact first in Eurozone and then the whole world for sure. Lehman Brothers unfolded on a Monday morning when people came to work. But here, we've already been talking about it for quite some time. There's enough room for everybody to adjust to it. We will not be immune to something like this going bust. If at all we are going to be affected, I can say this with confidence that we will be the first to bounce back.
Jose Antonio Alvarez, the CEO of Santander, one of Eurozone's biggest banks, said that liquidity in the banking sector was extraordinarily high and therefore did not see contagion risks in the sector. Even in the worst case scenario, any spillover from a potential Credit Suisse blowout will only have a transient impact on India's financial markets, whereas any contagion to Indian banking system is unlikely. Credit Suisse's Indian branch has a balance sheet size of just 20,732 crore as of FY22 end. But investors will be closely watching any action from the Swiss government and whether or not Credit Suisse will be able to execute its soon-to-be-released restructuring plan.
The ongoing global upheaval has played out differently for India. While it is getting cheap oil from Russia, the supply of natural gas has become a bit of an issue. And ahead of winter, Europe is making desperate attempts to purchase natural gas from sources other than Russia, putting Asia in a tight spot. What does it mean for India? Let's find out.
Natural gas is used to generate electricity and make fertilizers. It is also converted into CNG, which is used to run automobiles. It is converted to LNG and is imported by countries to meet their energy requirements. So natural gas is as essential as oil. Russia was the largest exporter of natural gas in 2021. But its invasion of Ukraine changed the equations and plunged Europe into an energy crisis. And the effect of Europe's energy crisis is slowly being felt in India too. It is threatening to derail its gas economy. Russia used to supply 40% of Europe's gas requirement before the Ukraine invasion, but it came down to 9%. Gas supplies to Germany were also hit as Russia cited Nord Stream 1 maintenance. The pipe, which runs under the Baltic Sea, is Germany's gas supply backbone and accounts for over 1/3 of Europe's gas supplies. This means that Europe is looking to get gas from other sources, which leaves very little for Asia. For instance, Russian gas producer Gazprom's supply to India has been dwindling since the start of the war. Europe is now expecting 90% more LNG on the spot market than they have secured under long-term contracts. Compared with last winter, European LNG imports are expected to be up 16%. So the spot LNG prices have soared and hit price-sensitive emerging markets badly. European gas futures are more than 4 times the price a year ago, according to ICE data. Europe's TTF gas futures benchmark, a gas trading platform in the Netherlands, went as high as £346.5, went as high as €346.5 per megawatt hour on August 26, jumping over 23 times from COVID-affected October 2020. According to reports, India is now looking for alternatives and has reached out to Iraq, Saudi Arabia, UAE, and the US to secure liquefied natural gas at affordable prices. Although the price declined towards the later end of September, it was still 27 times more than what Indian importers paid for spot supplies of the fuel in the late 2020. In India, spot LNG prices were 742 rupees per million British thermal units at August end, 135% higher than a year ago and 285% higher than 2 years ago. According to analysts, strong demand for LNG will make it difficult for India to compete in the global natural gas market. Matthew Carr, head of CarZ, a London-based clean energy intelligence provider, said that crazy high prices will slow the developing world's attempt to improve access to energy and electricity. Research analyst Sumit Pokharna tells more.
We are like 50% of our gas requirement is met from imports. So we will get impacted with if anything happens in the global markets. Considering that the geopolitical issues going on currently in the Ukraine and Russian and the fallout effect in other developed countries, we believe that this is an abnormal time and should not be taken as a situation which will persist for long. Definitely we are heading towards winter and the situation may get grave from here also. And in fact, the double whammy is that the rupee has also depreciated along with it. So in INR terms, the price is increased by 5.3 times since September 2021.
High gas prices have dent India's imports as Europe is sourcing most supplies by paying record prices ahead of the winter. In April-August period, India's LNG imports fell 10%. Domestic natural gas production rose to 34 billion cubic meters in FY 2022 from 28.3 billion cubic meters in FY 21. Gas consumption too fell by 10% in August from a year earlier. In the first quarter of current fiscal, gas consumption fell 2.5%. India's gas consumption is largely accounted by fertilizers, city gas distribution, power, and other sectors. Meanwhile, in India, local gas prices, which have revised twice every year, are linked to global benchmarks. So higher global benchmark prices mean that domestic prices would also rise. In line with that, the price of natural gas has been raised by 40% to a record high last Saturday. The record high local natural gas prices are likely to make CNG and PNG cost more. PNG prices have already risen 70% in the last 1 year. According to a report in the leading financial daily, Indian automakers have cut their production target for CNG-powered vehicles by 25 to 30%. City gas distribution companies are deliberating whether to pass on the cost or to absorb it and worried that the hike would impact sales volume due to lower offtake by industrial units. At present, around 85% of city gas distribution segment consumption is being met through domestic gas and the rest through imports. Research analyst Sumit Pokharna tells more.
There was a possibility that they could have postponed this gas hike or deferred it for some time because an expert committee is already working on a gas price issue. All countries globally are struggling with rising inflation, and government has taken very proactive steps by not increasing the retail fuel prices like petrol, diesel for quite some time. And that has contained our inflation to a large extent. But given that the price increase in the gas has happened, some impact on inflation will come on this. So the sectors which will get impacted will be city gas distribution companies, fertilizer sector. Just to put things in numbers, that will make the things very clear. For each and every US dollar MMBTU gas price increase, city gas distribution company need to raise CNG prices by 4 rupees 70 paisa to 4 rupees 90 paisa per kg. That is quite high. And considering that the gas price have moved up by $2.5 per MMBTU, we believe that along with the recent currency weakness, these city gas distribution companies like IGL, Mahanagar Gas, they might have to increase the CNG prices somewhere in the range of 12 to 14%, 14 rupees per kg, which translates to 15 to 19% of the existing prices.
Meanwhile, the steep hike in gas prices is expected to increase Centre's annual fertilizer subsidy bill. According to a Business Standard report, the fertilizer bill was estimated to have last risen to 2.3 trillion rupees as against budgeted 1.05 trillion rupees. On the upside, the rise in gas prices will likely boost earnings of ONGC, the key producer of domestic APM, and others like Oil India. Going forward, as we head towards winter, the gas prices are expected to remain elevated, impacting margins of CGD players and adding to inflation. In the longer term, India may need to expedite its shift to alternative sources of energy and reduce dependence on hydrocarbons.
Let us move on to financial markets now. Beginning next week, India Inc. will start delivering July to September quarter results for this fiscal year. While index heavyweight TCS will be the first to announce the result, HCL Technologies, Wipro and Infosys will later join the league. Our next report delves into what investors should expect from the Q2 earnings season and the market's trajectory thereon.
IT major TCS will kick off India Inc.'s earnings season for the second quarter of this fiscal year on October 10. A slew of IT companies like Wipro, HCL Technologies and Infosys will follow suit. In the previous quarter of this fiscal, corporate earnings saw double digits growth, driven by banks, NBFCs, oil and producers and FMCG companies. A Business Standard analysis showed that the combined net profit of nearly 3,000 listed companies had increased 22.4% year-on-year to 2.2 trillion rupees. However, higher material and energy costs dented margins in Q1 FY23. EBITDA margin for the entire sample was down nearly 410 basis points year-on-year to 22.5%. In Q2, however, bottom line growth is likely to suffer due to higher operational costs and inventory losses. Top line growth, meanwhile, may stay in double digits. Among sectors, top-tier IT firms are likely to post sequential revenue growth of up to 5% in constant currency terms amid demand concerns. Financials and automobile companies, on the flip side, could outperform in Q2 FY23.
In the coming Q2 results season, financials and autos are likely to come out with very good results. In financials, private sector banks like ICICI Bank, Kotak Bank and Axis Bank are likely to lead with excellent set of numbers. In PSU banks, Bank of Baroda and State Bank of India are likely to post very good results. In autos, passenger vehicle segments and commercial vehicle segments will come out with good results. In two-wheelers, Eicher Motors will come out with an excellent set of numbers. In IT, the results of Q2 will be good since the demand has been good during Q2, but there are concerns in the market regarding the slackening demand for IT services in the coming quarters. In other segments, capital goods, telecom, specialty chemicals, and domestic demand facing pharmaceutical companies will come out with good results. Apart from these segments, individual companies are likely to post very good results. A very good example would be Titan.
Moreover, analysts foresee metals, IT, and oil and gas to underperform in the quarter under review. This, they say, could downgrade Nifty EPS for FY23 by up to 3%.
Overall, for India Inc., we could see double-digit top-line growth. The performing sectors would be auto, FMCG, chemicals, especially specialty chemicals, BFSI, and those expected to underperform would be metals, IT, and oil and gas. The bottom line will suffer mostly due to operational cost inching up as well as inventory losses. Industry has been stocking up raw materials due to continuous rise as well as supply chain issues. But now with the prices retreating, we could be looking at inventory losses. The surprises would be specialty chemicals, which would be the biggest beneficiaries of disruption in Europe, and pharma could be the other one. Continued attrition and increasing operational costs along with slower order flows will keep the pressure on IT stocks. Overall, I would expect a slight downgrade in expected EPS of FY23.
Today, investors will closely watch out India's services PMI data for September. Besides, global cues, rupee movement, FII flows, and crude prices will continue to dictate markets on Thursday.
SEBI recently levied about 6 lakh rupees fine on 3 individuals for violating the insider trading norms in the shares of PVR Limited. It is not for the first time that the market regulator has acted tough against insider trading. But what exactly is insider trading? Our next report explains it in detail.
Insider trading, also known as insider dealing, is the malpractice of selling or buying securities such as equity and bonds by the insiders of a company. To prevent such acts and to promote fair trading in the market for the interest of the common investors, the Stock Market Regulator, Securities and Exchange Board of India, has prohibited firms from purchasing their own shares from the secondary market. Insider trading is one of the most serious malpractices that exists in the market. It basically refers to the buying, selling, or trading of shares or other securities such as bonds or stock options of a listed company using unpublished price-sensitive information that can affect the stock price that has not been disclosed yet. SEBI defines an insider as someone who has access to price-sensitive information about a particular company's shares or securities. An insider can be anyone who has been associated with the company in some way during the 6 months preceding the insider trade. That person could be an employee, a director, relative, banker, or legal counsel to the company, or even an official of the stock exchanges, trustees, employees, or of an asset management company that worked with the company. Insiders who have access to confidential and exclusive information about the issuer of a particular security or stock benefit from buying or selling securities before they fluctuate in price. UPSI refers to a piece of exclusive information related to a firm's stock prices, quarterly results, acquisition deals, mergers, or any kind of sensitive activities that have not been shared with the public at large. When insiders are able to access the UPSI, they illegally conduct trade dealings for personal gains. For example, a company director informs his friend about a yet-to-be-declared deal and the latter disseminates that information to his colleagues, who then buy the company's stocks. Then, the manager, his friend, and his colleagues are liable to be booked by SEBI for violation of Prohibition of Insider Trading Regulations. In India, insider trades are regulated by SEBI under the Insider Trading Regulations 2015. In fact, the market regulator can impose fines and prohibit individuals or entities from trading in the capital market if found in violation of rules.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Supreme Court recently held that mere possession of unpublished, price-sensitive information at the time of trading does not mean that the person is involved in insider trading. The court said that intent should also be considered while making the charges. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.